Why do some agencies struggle at £250,000 revenue while others are thriving at £1 million plus? I'll break it to you now. It's not about having more clients, better marketing, or cheaper resources. It's about implementing a profit framework that enables you to scale. My name's Rayhan Moghul. I'm a chartered accountant and the founder of Sidekick Accounting. I've helped hundreds of agencies make more money and pay less tax. And in this video, I'm going to run you through the 3 frameworks I employ in every single one of my clients' businesses when we are advising them on how they can increase their profits and scale beyond where they are today. The average agency in the UK right now is operating somewhere between 15 and 20% of net margin. That means for every £100,000 of revenue, they have £15,000 to £20,000 left in the bank, and that's before tax. Now, if you ask a lot of them, they'll think they're making 40% plus in margin, but the reality is they've failed to account for things properly, including expenses, revenue, and taxes. High-performing agencies are consistently hitting 40 to 50% net margin, which is enabling them to hire and to scale with ease. Master these 3 frameworks and you won't just improve your margins, you will fundamentally change the business that you have and the life that it enables you to live. So let's jump into it. Framework 1 is service optimization. What are you selling and what is actually making you money? Here's the truth. Not all revenue is generated equally. If you're doing £500,000 revenue, but 200k of that is coming from a service that only gets you 10% gross margin, the reality is you're going to be working very hard for very little return. To implement this framework, you need to start by analyzing every service that you offer across 3 dimensions. The first is gross margin, the second is delivery complexity, and the third is scalability. High-performing agencies focus on the services that have the best mix of those 3. This typically includes strategy work, consulting, and highly productized services. Lower performing and lower margin agencies tend to focus on more commoditized services. For example, high volume content production, basic social media management, templated website builds, and other things like this where somebody is shopping around on price. Doing too much also builds into your business model operational complexity, and I can guarantee you are incurring costs that you have not factored into your pricing as a result of doing too much across the board. What I mean by that is you're adding operational complexity into the business for things like managing the delivery of multiple different types of work, marketing that different work, and people having the expertise to deliver on that work effectively. There's also the mental and energy drain of you or your team jumping around 1 minute doing social media posts and the next minute answering a Slack message about a go-to-market strategy for a new app. Having to mentally switch from low value to high value tasks, or even just a large volume of different tasks every single day, has a mental impact that most people do not factor into their business. So this framework is about applying the 80-20 rule to your services. The idea here being 80% of your profit will come from 20% of your services. You need to identify what that 20% is. These should form your core services, and everything else is just noise. You can either optimize them to generate higher value and higher revenue, or you can phase them out. Why? Because you have limited resources and you want to put them into the things that are generating the highest return. Now, don't cut services overnight because this can be a cash flow nightmare. Instead, gradually phase out the services that are not making you enough money. This can be by increasing prices for existing clients where you're either delivering that work and it's profitable, or they naturally move on to somewhere else. Or it could just be not selling this product or service to any new customers and then just servicing the existing client base as you move forward. So now that you've got your service mix correct, framework number 2 is about margin optimization. How do you maximize the amount of money you make from the services that you're selling? High performers typically optimize all 3 at the same time. Let's start with lever number 1, pricing. Agencies often get pricing wrong because they're operating off what we call a cost plus pricing model rather than a value-based pricing model. Cost plus pricing is basically saying, okay, this costs us £3,000 to deliver. We want to make a 50% margin, so we're going to sell it for £6,000. Yes, there's a 50% margin. However, you are also leaving money on the table, especially if what you're delivering for that project is worth £50,000 to the client. What you're also doing is capping the maximum margin to 50%. And the reality is there may be some unplanned events like additional team time or additional costs or a longer project timeline that weren't factored in, which means that your 50% suddenly becomes 20%. Instead, you should operate through a value pricing model. If that service is worth £50,000 to the client, they're probably going to be pretty happy paying £15,000 for you to deliver it. The cost to deliver remains the same, but the price you sell it at has increased. So there you've got the same product now making an 80% margin because you've changed your pricing method. The second lever is delivery. This is about reducing the cost to deliver a service without impacting the client experience and without compromising on the deliverables. How do we do this? Well, high-performing agencies are extremely systemized. They have templates, SOPs, workflow, and clear responsibilities across the team so that things are not being dropped through the process and everyone knows exactly how to execute on a certain piece of work. You also want to consider AI and how that can be built into your workflows. Work that previously took 20 hours may now take 4 hours with the right workflow, with the same level of output being delivered to the client. The starting point to pull this lever is to understand the current gross margins for your projects. And lever 3, scope control, is where agencies are bleeding margin without knowing it. High performers have very clear scope boundaries that are contractual and communicated with the client through the sales process and after. Your retainer includes 3 strategy sessions and 3 reworks. Any additional reworks will be billed at X, and this will be communicated with you in advance. There's no ambiguity and very limited potential for scope creep. In addition to that, high performers implement the change request process. Any out of scope work requires written approval from the client and from the internal team to say, yes, we can deliver this within this time frame, and for the client to say, yes, I am willing to pay this amount. Yes, it sounds formal, but it protects your margin. And from experience, however friendly you are with a client, you want these things in writing, on paper, so there is no ambiguity in the future. And it's nothing personal, it's just business. Framework number 3 is cost structure optimization. Now you have 2 different types of cost in your business, fixed costs and variable costs. A lot of agencies jump into this in the wrong way. They load up on the fixed costs and they have very few variable costs. And as soon as a client leaves or doesn't pay them, they're stuck with a huge fixed cost that needs to go out and very limited flexibility to delay that payment or reduce that cost in the short term. Getting the mix right is where you build a foundation that can scale with the business sustainably. High-performing agencies operate a 40-60 split. That's where 40% of costs are fixed and 60% are variable. This gives them a lot of flexibility to be able to react quickly when things that are out of their control change, like a client churning. I'll give you some examples of questions you can ask. Look at your team. Do you need a fixed team of 8 designers, or could you have a core team of 4 and have 4 freelancers on hand for additional capacity as and when you need it? Then look at your revenue per head. Do you know how much revenue each fixed employee is generating? And do you know how much they cost? Typically, for a 50k employee in an agency, after national insurance and other costs of employment, that will cost your business £70,000 to £75,000 in a year. If you then use this person to generate £100,000 of revenue, you haven't got very much margin left. What you want to aim for is a revenue per head of 150k plus. And you can do this by having work allocated correctly across different levels. So senior team members are reviewing the work of junior team members who are assisted by variable freelancer costs as and when they need to. With AI and automation in play, having a revenue per head of 150k plus is pretty achievable with the right structure. And the next piece in this framework in terms of large outgoings that are fixed is your office cost. Do you need that big high street central London office, or could you operate remotely or hybrid with something a little bit further out? Some agencies want that presence and they're willing to pay for it. However, what it's doing is draining money out of your business, just like your fixed team are. Every month, you have to make the rental payment for that large office, even if you reduce your team size and your revenue drops. So ask yourself, do you need that expensive office, or could you operate hybrid or even remotely to reduce your fixed costs? There are a lot of other costs you need to consider in this exercise, like software subscriptions and technology. However, we won't cover them now. Principle is remaining the same. Follow this framework to assess your costs, fixed versus variable, and aim to have the right mix that gives you flexibility and security in the event of things changing that are out of your control. So those were the 3 frameworks. If you actively work to implement these in your agency, you will go from a low performing agency doing 15 to 20% margins to a high performing agency doing between 40 and 50% margins consistently. To make this really easy and enable you to get visibility into your agency's performance fast, I've linked our financial planning template to the description below for you to download for free. You can input your agency's numbers and get output that helps you to make the right decisions. As always, if you found this video useful, give it a thumbs up and subscribe to my channel for more agency finance content.